Uh, I, I would like if everybody would stand for a moment of silence for Representative Ryan, whose wake and funeral is today and tomorrow. Thank you. Just to sort of set the ground rules, we have a hard stop at 3:00. If we do not answer your question and you have a question in either the Finance Committee or the Appropriations Committee, please send us your question. We will get them answered, and we will, my goal is to have them, the answers to those questions published on the Appropriations and Finances web pages, whatever we're calling them these days. So, yeah, so we'll publish them, the question and the answer, so that you can see what the question was and the answer. And we're not going to differentiate. We're going to put both the questions, whether they're finance or appropriations, on both respective web pages. And we have given honor to Representative Ryan, and now for a good honoring. There is one person who's here today who this is his last meeting with us. And I personally want to thank Secretary Beckham for I know he doesn't want to be recognized. He's going to be a judge. I'm saying this so that if I ever end up in front of him, he knows that I really appreciated working with him. No, all joking aside, I really appreciated working with you, Jeff. You've always been honest with Representative Walker and myself, and I thank you so much for all that you have done for both the state, but also in working with the legislature. And I'd like to give him a round of applause. All righty. So we have a hard stop at 3 again. So we're going to go right into this. Neil, you're kicking us off.
That's as I understand it.
All righty. Anybody else want to say anything right to begin with? Okay, everybody's okay. You're good to go.
All right, let me see if I can get the technology going here. Just a sec.
That is something that I am not helping you with.
Gotta share the screen. Hang on a sec. Hold on. Okay. Good afternoon. I'm Neil Ayers of the Office of Fiscal Analysis, and welcome to the 2025 Fiscal Accountability Report. Welcome to the 2025 Fiscal Accountability Report. It's been a while since I did this. Sorry. First off, a couple notes before we get into the presentation of the report. You folks passed Special Act 25-1 in November. The governor signed this 2 days before our report was due. We opted not to change all the numbers at the last minute and screw them up and incorporate that. What that bill did, reflected in our report, that transferred $500 million from volatility funds into the budget reserve fund, rainy day fund. This precludes a reduction in the state employees' retirement and teachers' retirement payments that would have been $41.5 million that would have been incurred in FY27. Those funds have yet to be determined what's going to happen with those in the budget reserve fund. So in the out years 28 and beyond, if none of those dollars are spent, it would flow into the the retirement funds, and there'd be no out year impact. If all of those $500 million are spent, the out year impact 28 and beyond would be that $41.5 million in lost savings. Some of it spent, it would be somewhere in between those.
Can you hold on one second? Senator Kushner, you have your hand up. Are you trying to speak now?
Yeah, it's really almost impossible to hear. I can hear you, but I cannot hear the mic that Neil is speaking into. I don't know if other people are having problems with that, but I certainly can't.
We're going to try and see if we can move to another mic. Thank you.
Thank you.
Any better?
Much better. Thank you.
Okay, there's a microphone issue. Okay, so those figures are not included in OFA's fiscal accountability report. Secondly, you folks last year made a couple changes in the required report. Previously, we were only able to increase in our estimates items that were considered fixed costs. The change that was passed allowed us to take a look at material likely changes in non-fixed costs as well. And secondly, it added a requirement for us to take a look at the state's preparedness for a recession. So it's a budgetary stress test. Okay, so today we are going to look at the general fund in the current biennium, 26 and 27. We're going to look at the out years for the general fund that goes out through FY30 in this report. We will look at that budget reserve fund and stress test. We'll identify a few economic trends that we called out within our report. We will look at the state's bonding and those figures that are underlying the budget estimates. We will take a look at, a special note to everyone here, special transportation fund. And finally, we're required to take a look at tax expenditures. So current fiscal year FY26, as passed, it had about a $308 million surplus. Through all our adjustments and our estimates, we're now estimating that surplus at about $95 million. In November's consensus revenue estimates adopted between OFA and OPM, generally the income tax portions are performing pretty well. The estimates and finals and pass-through entity tax finished FY25 very strongly, so that base got built in. That doesn't help your balance because we're already above the volatility threshold. Those will be additional payments to the retirement funds. Withholding, we made an upwards adjustment of about $216 million. I think that's about a 4% annual growth rate. Sales and use is also of note. When we did the April consensus, I believe we were anticipating basically flat growth there. It's actually outperformed, and we now have an estimate of about 2% annualized growth. On the negative side, the biggest thing is in corporation taxes. We made a downward adjustment of about $120 million based on performance of this. This is a nationwide thing. The federal corporation tax receipts are down about 14% as well. I know a lot of other states are realizing this as well. We also made an adjustment of about $137 million to the negative based on recent changes in federal law. So all said and done, from April to November, we adjusted net general fund revenue by $11 million. Not much there. On the expenditure side, there's a total additional expenditures net of about $225 million. We'll detail those on the next page. Up top, we identified total lapses of about $74 million. The largest of this is due to basically an accounting change for the higher education alternative retirement program. That's now lapsing about $30 million. Overall expenditure trends, about $21.1 million lapsing. This from a variety of accounts, most of which is in DSS's temporary family assistance, Saga and Husky B. It's about $18 million lapsing in those accounts. And finally, about $14 million estimated lapse in debt service just based on our current trends. To the bad side, we are identifying about $268 million in deficiencies. The largest of this is state employee benefits. This is basically in active and retiree health costs. We have been seeing medical services having about an 8.4% increase in cost and pharmacy growing by about 13.7%. Next biggest category is Medicaid. Again, hospital and pharmacy costs are running above what was budgeted. And in addition, we made an adjustment for anticipated increases for the covered Connecticut costs due to expiring enhanced federal subsidies. Catch-all down next biggest is $46 million in caseload and cost pressures. This is across 11 agencies and a variety of programs. About half of it is related to housing costs in the Department of Housing and medical costs in the Department of Corrections. Next largest is adjudicated claims. This is an account that is not normally budgeted for, but we incur costs every year. We're estimating about 30 million by the end of the year. We've incurred about 9.7 million to date. Personal services cost, that's reflecting estimated deficiencies across 5 agencies, the largest of which are judicial, corrections, DEMIS, and DESP. And finally, the technical one down in the bottom, the unallocated lapse, the budget that you adopted included bottom line lapses of about $94.2 million. OPM has taken action through holdbacks and other mechanisms to identify about $60 million of that savings. So that would leave 31 million yet to be identified. So mix the whole column together. We're expecting expenditures about $225 million in excess of budget. Moving on to the second year, we just saw the FY26 numbers. Second year, FY27 upcoming, budget as passed had a balance of about $550 million through various adjustments and expenditures and revenues. We're now down to about $312 million. On the expenditure side, there's nothing terribly interesting to call out. It's basically very annualizing the trends we're seeing in FY26. On the revenue side, call attention to a couple of things. We are expecting negative growth in the estimates and finals and pass-through entity tax, which is assuming a pullback in the equity market at some point, which will mute capital gains realizations. We have a downward revision in inheritance and estate taxes of about $55 million. This relates to a change in the federal tax thresholds. In the federal grants, there are 2 major adjustments. That's a catch-all again, but the 2 major ones is in the HR 1 bill passed by the feds this summer, had a decrease in the federal share of supplemental nutrition assistance administrative costs. We get those via federal revenue, the federal share. So basically the federal revenue is going down related to that. And we're also anticipating some lower revenue related to hospital supplemental payments. Going into the out years. This picture down in the bottom, when I first started doing this, was much, much worse. It looked like an alligator attacking a hippo. The revenue and expenditures were not in line. The good side for 28, 29, and 30, we're projecting modest surpluses in each of those years, or positive balances and those surpluses. I would note that these positive balances are after a volatility adjustment. So there's still volatility payments on top of these balances. This would just be the operating projection. The biggest couple changes coming out of the FY26-27 biennium into 28. There's a couple technical things. The biennial budget that you adopted credited about $245 million in FY26 revenue to help balance FY27. It's a common thing you folks do over a course of biennium to smooth revenue between the 2 years. That revenue, because it was 26 into 27, is not available in 28. So there's a negative adjustment there. And there also is, and a little more detail on this later, there in the biennial budget, there was some revenue transfers from the general fund to a couple other funds. Those aren't in statute in the out years, so we're not reflecting them. So these positive balances for the general fund are somewhat inflated, and those other funds would be underinflated, if you will. Couple of changes in the corporation tax related to HR1. There was a negative adjustment of about $100 million related to qualified production facilities, as well as adjustment for research and experimental expensing. Those are the biggest changes 27 to 28. Looking at the kind of the organic revenue growth in the out years, this is pulling off any policy changes you adopted or technicals, so just the economic trends. As you can see, we are projecting growth between 2.7 and 3% on revenue in all the out years. The flip side of the revenue is your costs. This one, for those of you who've been here before, is a common one. As I said, we used to just be able to show growth in fixed cost. These are your fixed costs. Your biggest category is entitlements. This is mainly Medicaid. That's followed up by debt service and state employee pension, retiree health, and teachers retirement and retiree health. Last category is hospital supplemental, and you can't even really see the line way up top there. There's a red line of about like $30 or so million for adjudicated claims. Fixed costs represent about 54% of the budget going out, and we have them growing collectively at about 4% a year. New for this year, non-fixed cost growth. Past reports were required to keep these all flat, which is not terribly realistic. OFA did not apply an across-the-board inflation. Our analysts took a look at areas that they thought would be cost pressures that would likely be realized even in non-fixed costs. Biggest category is the state employee. We have not part of any negotiations. I don't have no insight on what the contracts are going to be. We put in these estimates just based on some past patterns. So some significant likely increases related to CBAC. The private providers, you passed PA 25-151 last year that required increases to private provider contracts. We're estimating these between about $75 and $80 million a year in the out years. And finally, we're reflecting some cost pressures and fringe benefits, which are mainly in active employee health services. So if you look at your fixed and non-fixed cost against just your organic revenue growth without the technical stuff I had talked about, you are not exactly in balance all 3 years. But mind you, these are on a basis of about a $28 billion budget by that year. So there's a slight structural imbalance in 2 out of the 3 out years. This is much better than the $2, $3, $4 billion imbalances we were showing a few years ago in these. So moving on to what's not in these numbers. Couple of things, fiscal pressures that are outside the current projections. First off, HR1, OBB, whatever you want to call the bill passed by the federal Congress last summer. We identified and included in these projections a few that we're aware of, the higher SNAP or the higher state share of SNAP administration, some of the tax policies, the inheritance tax and the corp tax impacts. However, there are a lot of, that was somewhat of a backloaded bill. A lot of the impacts are likely coming in the out years, and they're not well-defined or have regs out yet. We don't necessarily know what those numbers are going to be. There are going to be impacts. We can tell you that. We can't put a number to them yet. As I said before, there's 2 transfers in the current biennium that aren't in statute in the out years, so we didn't include them. There's about $100 million that goes to the Municipal Revenue Sharing Fund and about $10 million to the Cannabis Regulatory Fund. These aren't in our numbers, so again, the general fund balance is a little overstated for those years. And finally, there's the additional deposits at the pension system that we discussed up front related to the $500 million you folks set aside last month. Moving on to the Budget Reserve Fund. There's not there's a lot of numbers here. I'm sorry for that, but there's not a lot of detail you need to know. I'd go down to the bottom. The biggest takeaway is we're projecting the Budget Reserve Fund to be at its 18% statutory max in each of the years covered by this report. And that is in addition to going up 2 lines, additional funds that will be going to reduce the long-term debt. So we're anticipating the Budget Reserve Fund will be full, and we'll be making additional volatility deposits between about $2 billion and $600 million each of the years. So that is a generally pretty solid, healthy look, unless we have a recession. So the new format required us to take a look at how well we are positioned to deal with the recession. So what we modeled, we took, we don't know when there's going to be a recession, if there's going to be a recession. We modeled this on FY 26-27 adopted budget. Generally, when there's a recession, there is a 2-year revenue shock, if you will. There's a particular way our taxes come in, a lot related to Wall Street. We tend to get a significant drop. The Budget Reserve Fund, one of the legal uses for it is to backfill lost revenue. So we were modeling it in this regard. In addition to the Budget Reserve Fund, in these situations, because of the way the volatility cap works, you can only budget up to X, and whatever's above that, you can't use to balance a budget. If you get a revenue shock, that top part comes down first before you ever need to hit the resources of your Budget Reserve Fund. So it's basically an extra cushion, if you will. So I think we include that in what your reserves essentially are if you're looking at a budget shock or a revenue shock. So total protection is about $7.8 billion. We looked at 2 of the more recent ones, the dot-com recession. That was a 2-year revenue loss of about $5.7 billion. On the other end of it, the Great Recession was a 2-year revenue loss of about $8.2 billion. The middle one's literally just between those 2. As you can see, outside the Great Recession, the reserves you have available, had this have hit in the current biennium, would have been enough to weather the dot-com or a median recession, not quite on a Great Recession. The caveats on this are what's not in this example. We just modeled the revenue shock. In course of a recession, oftentimes you as policymakers will make additional spending to address concerns. That's not included in this. In the past, when there's been recessions, the federal government has often got extra funds out to the states to try to dampen the impact on the streets, if you will, often through like an enhanced Medicaid match. We did not assume any additional federal revenue for this. This is purely the state's resources to deal with it. The other large difference in this, I think, is somewhat different than how we modeled and then how OPM modeled it. I don't think either's right or wrong. They're just 2 different methods. Coming out of a revenue shock recession, oftentimes your revenue base is now lower. So if you had perfectly balanced expenditures versus perfectly balanced revenue, you get a recession, that revenue coming out of that is probably going to be lower. It basically will have redeveloped a structural deficiency going forward. We did not, because the Budget Reserve Fund is only supposed to backfill immediately lost revenue. That would present outside this 2-year window, a policy discussion among you folks of how to address that going forward. So that's not included in this model. Okay, we'll get out of all the numbers for a few minutes and look at some pictures, economic trends our folks are looking at. The Connecticut Real Growth Rate product. We have traditionally lagged the country decently by this. This chart has Connecticut in the red, the U.S. as a whole checked. What is interesting is that we have been catching up. The disparities between the U.S. and the country as a whole have diminished. And in the second quarter of 2025, Connecticut actually grew at an annualized rate about 4.6, which outpaced the U.S. as a whole U.S. as a whole is at 3.8. Hopefully that is a good trend going forward. Looking at the population in the labor market, up top here, the takeaways, we're getting older. Our fastest growing cohort is age 65 and older. And we think that's starting to show up in the labor force participation rates down below. Our labor force participation rate had caught up to from the Great Recession. We got back up to those levels. But if you notice in the far right, it's starting to tail off again. And there's some concern that this is indicative of this aging labor market, which may employees maybe start to find it difficult to find people to hire if this is an ongoing trend. This is just taking a look at a snapshot of Connecticut's employment changes by industry. Overall, over the last August to August, Connecticut gained about 12,700 jobs, which is 0.7%. And what this is showing is education, health services, professional and business services and leisure and hospitality growing very strongly, which is helping offset manufacturing and construction losses. U.S. Consumer Price Index. This has, looking at both CPI and CPI core, which takes out energy and food, had come back down and recently is ticking back up to around 3%. As I mentioned earlier, we're projecting our sales tax revenue, which is closely tied to consumer price index, is only at about 2%. So there's been we think there's somewhat a divergent path there, which I believe the next slide will hopefully illustrate. The spending has remained resilient despite uncertainty, consumer spending. But what has definitely developed is a divergence between low-income consumer spending and the higher-income consumer spending. At the lower end, 0 to 60,000 or so in income has grown about 8%, whereas at the higher end, it's growing at about 17%. This may be indicative, if I've read articles or whatever on a K-shaped recovery. This is what they're talking about. And down below, the largest quintile of our population represents about 55% of our total disposable personal income. So there's a bit of a dichotomy that's developed there. And lastly, just taking a look at the active housing inventory. It actually has, over the past year or so, ticked up about 7.4%, but this is still about 80% off its 2016 level. Okay, moving on to bonding. These are just basically the numbers that underpin the assumptions that are included in our balance calculations. Overall, you have authorizations. That's what you folks approve every year. We're assuming about 2.6 billion in new authorizations annually. Next down is the allocations. That is what State Bond Commission deals with every year. That's subject to a separate allocation cap. We are assuming that the allocations will be at about 95% of the total allocation cap every year. And issuances, which is what the treasurer actually goes out and issues each year, we're assuming for the course of the report about $2 billion in issuance per year, plus some for Yukon 2000. What this all means is in our budget projections, we have the last line of debt service about varying between about $2.5 billion to $3 billion in debt service, which was included in that fixed cost chart we showed a little bit ago. This is just a quick illustration of the actual project bond spending. Peaked at about 2.4 billion in 2016, dropped all the way down to just shy of 1.3 in 2023. It has come up a decent amount in the last couple of years. Special Transportation Fund. So generally, the takeaway from before is, barring recession, the general fund is in decent shape. You'll have some decision to make, as you always do, but it's in decent shape for now. It is not necessarily the story for the Special Transportation Fund. Traditionally, the Special Transportation Fund was supported by fuel taxes. Drive a car, use the road, you're paying for the road. Cars have become more efficient, people are driving less. The growth in fuel taxes hasn't been enough to keep up with expenditures in the Special Transportation Fund. A few years back, you folks made a couple changes. You dedicated a 0.5 point from the sales tax, the regular sales tax, moved that from the general fund to the Special Transportation Fund. And you also took all the sales tax for motor vehicle sales and put it in. That helped bolster the transportation fund's health in the short term, but now we're seeing the trends come back. For the current biennium 26 and 27, you also took extra revenue from the transportation fund in FY25 and credited it to those 2 years, which helped keep it solvent for them, those 2 years. The underlying trends are coming into play. If you notice the red deficit numbers in 28, 29, and 30. Those, again, it's on a smaller total fund. That's not the $27 billion of the general fund. It's the $2.5 billion of the transportation fund. That's going to cause a problem. The transportation fund normally has a cumulative balance. With these out-year projections of the negative 180, 255, and 322, that would eat up the cumulative balance of the transportation fund by 2030, leaving that fund insolvent. Your basic problem, this is what I was talking before, your expenditures are growing there at about 4% on average in the out years, mainly driven by that debt service 6.8% growth. The sales and use tax, that's what's coming from the previous general fund, is growing 2.6% for these years. All others, which is mostly the fuel tax, is only growing at 1.4%. So you have a divergence with your expenditure growth versus your revenue growth. And that's something it's not an FY27, which we're coming in to deal with, but that's something you all are going to have to deal with within a few years. Last thing we're required to report upon are tax expenditures. Tax expenditures are basically foregone revenue. It's taxes that normally would be collected, but through policies you adopt, we forego those. It can be done through a credit, which directly reduces the taxpayer's liability. It can be an exemption, excluding specific transactions, groceries, pharmacies, pharmaceuticals, or a deduction. Reduces a taxpayer's taxable income, like I have 2 kids in college, like a check contribution. These total, as I said, about 10 to $11 billion over the course of the report. The largest category, over half, is in the sales and use tax. This represents the FY26 sales and use exemptions. The largest one by far is in consumer goods. The 3 biggest categories there are prescription medicines, food products, groceries, and motor vehicle fuels. They're exempted here because they're taxed in a separate manner. The next biggest exemption is government. We don't like to tax ourselves. And the next broad category would be service exemptions. Largest 2 are patient care services and computer and data processing. For all of you that love everything about tax expenditures, OFA every 2 years is required to produce a comprehensive tax expenditure report, and that is due next month. So with that, as I understand, we'll take questions after, but before I turn it over, I just want to thank Janelle and the FAR team at OFA, and frankly, everyone upstairs at OFA. You guys have an incredibly talented and dedicated group of employees up there working for you. And I actually want to give my congratulations. One of the few people working around this building longer than me at this point, I think. So I wish you the best of luck.
Okay, Mr. Secretary, you're up.
Thank you. Thank you, Madam Chairman, ranking members, distinguished members of the Appropriations and Finance Committee, both present and online. And thank you, Neil, for those kind words. And thank you, Madam Chairman, for those kind words before. While Neil gets my presentation keyed up here, I'll just start by saying we're here on the Fiscal Accountability Report, which we do every year with OFA. Every year we get the same question. Representative Walker hit me with this as we came in. Why are they so different? They have different numbers. Well, we're a different staff. We come at this in a different way. We have different perspectives. I think the numbers are pretty close, and I don't disagree with anything I heard Neil say really in substantial measure. And I think if you look at both of them together, you get a really good overview, albeit from different angles on each question. He talks extensively about some things that we don't talk about at all, and vice versa in our report. But I think if you read them together, they're pretty informative. I would find them so. So this year, last year, you guys made changes to make this a little bit bigger. We're supposed to also talk about material and likely changes to non-fixed costs. Historically, this report was about revenue versus fixed costs, and we had good news the last couple of years. The revenue was growing faster than fixed costs. That's a good place to be. As you can see from Neil's report, and as you're going to see from mine, that trend may be coming to an end, but we hope not. One more thing, I'll just draw your attention to our report. It's about 60 pages, but the overview, the headlines are really on pages 1 and 2 in our overview section. We're going to talk about the current year, but going forward, I just want to draw your attention to, while the revenues and expenditures over the revenue, the period that we're studying do remain closely aligned. I think Neil was showing a slight structural deficit in the out years. We think they're pretty close, and I'll show you my numbers in a second. We have an asterisk that I'll tell you about in terms of why we think they're still closely aligned. But our estimate of expenditure growth in this report reflects not only the inclusion of non-fixed costs, but includes inflationary growth beginning in 28 for private provider grants, and Neil mentioned that, as well as most other goods and services, in order to present what we think is a realistic picture of anticipated future cost trends. Our pension costs, as you'll see, for state employees and retirees are expected to shrink relative to the general the budget itself. They're level now, and they're going down in real terms in the out years, but they're shrinking relative to the size of the state budget. That's a good thing. But we agree, and I could see we agree on what the top drivers of costs are. It is those active and retiree healthcare costs. Neil referred to entitlements. That's principally Medicaid, as well as debt service, which are going to be growing in the near future. And of course, they've also identified the problem that we see in the STF, the Transportation Fund. As you'll see in our numbers, we see it going into the red next fiscal year, not 28. So we're concerned about the STF. In fact, we conclude that given the slow growth of projected revenues available to the fund, these cost increases in the STF are not sustainable and will necessitate additional revenue or reductions in transportation investments in order to maintain that fund solvency on an operating basis. Neil pointed out we do have a cumulative balance of about $450 million in the STF, and you can, that is an option for you to use some of that to balance, but we would have, or the executive has the obligation to propose a balanced budget, and you have an obligation to enact one, and I'm not sure that use of the cumulative surplus for balance would be something I would recommend. So with that, I'm going to get you started here to tell you we're going to talk about the current year, which is FY26, and where we are with the budgets, the operating surplus in both the STF and the general fund. We're going to talk about next fiscal year 27 and the 3 years that follow through FY30. We're going to, as Neil did, talk about the budget reserve and the newly required recession stress test, as well as the long-term obligations and those major cost drivers, and reiterate in our conclusions what I just talked to you about. So starting with this current year, this reflects consensus revenue with OFA, as well as our last comptroller's letter. If you're a reader of our monthly letter to the comptroller, you can see that we project deficiencies and lapses every month, what's going on in the current year, and this is where we are. We're off. We started when you enacted the budget for this fiscal year, we were looking at a $309 million operating surplus. That's now down by $144 million. the operating surplus reflects the 164 million, and all of that will, under current law, go to the early childhood education endowment. Just to give you a little more flavor on, so the revenue is actually positive, albeit only by 11 million. So we're up 11 million net. On this slide, if you add up the green bars and then subtract the sum of the red bars, you get the $11.4 million. The blue bars don't count because that's the volatile revenue. That's going to the budget reserve and ultimately to the waterfall if it's filled up to the 18% level. But the net 11 million in revenue where we are shows you those tax types. Neil talked about the corp tax and the impact of the federal law, the recently passed Federal Reconciliation Act on that. That's part of the reason for the corp tax is off. Because we follow the federal as our starting point, the federal liability for our starting point, their changes to those expensing provisions relative to research and experimental expenditures will have about $136 million impact on our revenues. The other part of it, though, is simply weak economic performance being experienced by corporations generally. Lots of macroeconomic things going on there. They're not hitting their earnings targets for one reason or another. Perhaps the tariffs are kicking in, but we are seeing corp tax is off. But the rest of those tax types, as you can see in those bars stretching out, estimates and finals still going great guns. The stock market's still where it is, and that's mostly capital gains. On the expense side, this is what we're showing for deficiencies. Every month we tell you where we are with deficiencies. We have about 151 million that we've identified. The largest single one there is DSS. That's principally Medicaid. And we have a slide on Medicaid upcoming. In terms of next year and the following 3 years, where are we with revenue and expenditures and what do we think is going to be happening? As I indicated, we're showing here that forecast revenue growth is approximately equal to the forecast increases in expenditure requirements. I think Neil did show you from their perspective, slight imbalance in the out years. It's pretty close. It's a $25 billion issue, $26 billion issue. So if we're off by 100 million or 200 million, that's not a huge swing. The asterisk that I mentioned before is that the revenues and expenditures here assume what we did back during the regular session. You may recall the federal government was contemplating changes to the way in which states do the hospital provider tax system and the related supplemental payments. We were trying to hit a deadline after which we could not change that law. So we were trying to make changes and maximize federal revenue. We collectively were trying to do this, not just the administration. And you enacted a change that we proposed, agreed with, to maximize federal revenue. So it accounts for $235 million of revenue related to that. That number is probably going to be something we will be the administration will be talking to you about in February, as well as what's the corresponding supplemental payment going to be to match that. So it has the one without the other, so that's the asterisk in terms of those long-term numbers. Those will change presumably after this session. But that was the general fund, and as Neil indicated, we're pretty close there. Not a huge structural problem, at least not so far, if the economy holds up in the general fund. But this is the special transportation fund, and we do have some problems here. Revenue growth in the STF is inadequate to support the current spending trends. Our numbers are showing you there in the third row down, second column from the left, that we are negative next fiscal year, and it gets bigger in the out years. Debt service is one of the biggest drivers there. It's going to be growing at an average annual rate of 7.6% in the out years. We've got to make some changes there. Those discussions are underway internally with DOT and OPM. We'll have to come up with some options to get that back in balance. As I say, we do have the obligation to propose, and you have the obligation to enact balanced funds across the budget. Moving to the budget reserve and the now required recession stress test. Just to get you into that, you've seen this slide before. This is the history of our budget reserve fund. You can see those big down, this is withdrawals are obviously in red, the deposits are in yellow. We like the yellow, we don't like the red. The history going back to the turn of the century, literally, is that you had two big dips there. That was the dot-com recession in 2002, and then the Great Recession in 2009-10. We had a very sluggish period thereafter, the so-called lost decade, very difficult revenue years, lots of deficit mitigation and that sort of thing. But we had a big refill in 18-19 that was principally around some changes made at the federal tax level that repatriated a bunch of wealth back to our state from offshore. probably not due to be replicated in our lifetimes. It was a unique situation, as well as we've had a tremendous stock market in the last, whatever that is, 6, 8 years, and it continues to grow there. So we're at 4.3 billion now. It's at its 18% maximum. We're in a good spot with the budget reserve. So our stress test, we did it slightly differently, and I'll tell you on the next slide why it looks a little different. We did it over a 4-year period for the forecast period, and we have a more, I would say, pessimistic view of what will happen. So in the mild revenue loss scenario, there's the budget reserve line, 4.3 billion available. If you use just the budget reserve and you don't raise taxes and you don't cut spending, a mild revenue loss in a mild recession would take you down 2.9 billion. You'd still have about 1.3 or 4 left in the budget reserve. So we'd be well positioned for a mild recession. A moderate revenue loss would consume all of the reserve, and you'd be down $1.4 billion. You'd have to figure out what to do in the out years. And then, of course, in the severe Great Recession scenario, it would consume all of the budget reserve, and you'd still have about a $4.5 billion problem, but you'd have to do make other efforts. Now, for those of us who were here in 08 and 09 and 10, you recall we did in fact have an $8 billion problem at one point. And fortunately, we did have a federal government that threw about $2 billion at us. We cut some spending, we raised some taxes, and horrifyingly, we borrowed money. We borrowed earned recovery notes for about $1 billion that was paid off during the Malloy years. So we're better positioned today. We've got 4.3 billion available, but we'd still have about a $4.5 billion problem in a Great Recession scenario. Showing that over time, we think that it would happen over a number of years, and so you would decline as depicted in this exhibit, the same numbers but just shown over the 4-year period. We only projected out to 4 because that's what the FAR requires us to do, is to show you the out years. But recessions, as you saw with the Great Recession, we had sluggish growth for about a decade. It was tough. So you wouldn't bounce back to being okay in year 5. You'd still have problems in years 5 and 6 especially in the Great Recession scenario. So good news, we're much better positioned than we were. But if we have a bad recession, the budget reserve by itself will not be enough. So the volatile revenues, you've seen this before too. As you can see, they are quite volatile. They bounce up, they bounce down. That's principally the behavior of the stock market in those years. It corresponds to those recessions that I talked about, the one in the early 2000s and, of course, the Great Recession. You notice on our graph it calms down, but that's just our estimate and our forecast. That's not real. That's just what we're putting in as a kind of a placeholder. Like, we hope that's what happens. But if past is prologue, you could easily see in front of us what you see behind us, which is wild swings, and we just don't know. So just to give you a little more detail here, current fiscal year, about 72.3% of our volatile revenues are being deposited in the general fund, and the remaining 27.7% is subject to the volatility cap and is being set aside. And those volatile revenues, as you see in the second bullet, represent about 1/4 of our net general fund net revenue. So we have had great luck in the last 6 years of being able to make additional deposits to the pension funds because of what we call the waterfall. We've done about $10.1 billion. You can see by year how much we've been able to set aside. And that has had the effect in the second chart of reducing our ADEC obligations. We refer to this at OPM as the all things being equal chart, because obviously many things affect what your ADEC is, the performance of the fund itself, as well as the experience of what has to be paid out. But if you just, you could attribute that much savings to those deposits of paying down the principal. We're up to $857 million. That is more room in the general fund that you can spend because of these savings that we've been able to pour over the last several years.
Knows charters, and I think she worked with my son.
Exactly. To sum up, the last couple of years, we've had 8 consecutive budget surpluses. We've had 8 credit rating upgrades. I've had the pleasure of at least 8 bond rating agency presentation rounds. They're exhausting. They ask great questions, but they love the guardrails, ladies and gentlemen, and they have graded us because we've stuck to them. The budget reserve is at its 18%, and as I mentioned, we've done $10.1 billion in reduction of our debt, and that's resulted in $857 million in annual savings for the next 25 years in our general fund because of that, those efforts. And by the way, kudos to everybody, not just the administration. Obviously, the General Assembly has passed those budgets as well and passed those guardrails, and we should all pat ourselves on the back for that great progress. Our long-term obligations and major cost drivers. You've seen this slide before. This is all of our long-term liabilities. The largest single one is bonded indebtedness. We're one of the most bonded indebted states in the nation. This is where I get the "but we don't have counties" argument. Even if with the counties, we're way up there without the counties. I'll draw your attention to the red box. 5 years ago, the total was $95 million. We've got it down to under 80 at 79.6. Great progress. We're $15 billion better than we were 5 years ago in terms of our long-term liabilities. Still some work to do, though, as you can see. Pension funding, that's a good news story. In 2018, the CSRS funded liability was at 37%. It's now at 60. The TERS, the Teachers Retirement System, in 2018 was at 52. It's now at 64% funded. Combined, we're showing that they're both at 60 or just above 60 for how much of the funding we have provided for. So one of our big cost drivers, Neil referred to entitlements. We isolate Medicaid as a big driver here. As you can see, enrollment has declined recently, but it does remain higher than pre-pandemic levels. And those costs per case continue to be very high, and the utilization continues to trend upward. The growth is driven by higher costs to serve, among others, the elderly, blind, and disabled. As you can see in the second chart, they're 9% of enrollees, but they're 39% of expenditures. Kids are about 35% of enrollees, but only 17% of expenditures. And obviously everyone knows by now that recent federal policy changes are expected to have a state fiscal impact. The federal government, at least at the moment, appears to be trying to shift these costs to the states. So that's going to be a real challenge for both the administration and the legislature as we go forward. State employee and retiree health care. As you can see, we've had pretty modest growth. It was pretty flat up until recently. We are now projecting that it's going to have significant out-year growth, particularly for retiree healthcare, projected to experience an increase of more than 30% in the out years. So some real work to be done here to try and control those costs. I know the governor will have proposals in February around healthcare affordability and around this issue as well. Debt service. Debt service is a big driver. I think it's going to go up 22%. As we said in our report, over the report period, it's going up 5% a year over the next 4 or 5 years. The line above shows you the percentage of debt service against the total budget. And as you can see, it's a pretty flat. We're staying in a nice range. The trouble is that range of 10 or 11% is very high compared to our sister states. That's a lot of debt service relative to your general budget. And that's going up in dollar amounts, big dollar amounts every year. As you can see, that's money you have to spend, and it takes away, crowds out everything else that you want to do in the budget. So debt service, we need to get that, need to grapple with that issue. One other way of looking at that is our recent history of our general obligation bonding levels. The blue bars are the authorizations, the amount of the authorizations in the Bond Act every year. The orange bars represent that year's allocation cap. There's a statutory cap on how much the State Bond Commission can allocate on an annual basis. It's one of the guardrails secured by bond covenants. The red line shows you the issuance number. Issuance varies a little bit from allocation because the Treasurer's Office, of course, times when they go into the market on the bonding, so doesn't tie directly to the allocation level per year. But it's that issuance then that drives the debt service. Those are the bonds that get sold, for which we have to then pay the debt service for 20 years, usually. So the allocation cap does go up a little bit every year, but as you can see in recent years, the amount that's being authorized on an annual basis exceeds the amount that we can allocate. So that's a troubling trend. We're not going to be able to sustain that, and that needs to be probably looked at as we go forward. The Yukon 2000, we note here, it is an automatic allocation, but it's outside the allocation cap, doesn't count against the allocation cap, does count against your debt service though, so that's something we have to take a look at. Neil's tax expenditure chart is our selected tax credits chart. Same requirement. We're reading it this way. We also have a section in the report on this. Here we're showing business tax credits versus personal income tax credits. We're noting here for your continued information that the film production tax credit accounts for about 40% of all business tax credits. In fact, if you add the film production infrastructure credit, which is about the fifth or sixth one down there, it's actually 45 or 46% for that particular industry. It's an awful lot of money. I think we showed you in an exhibit last year that it was $1.5 billion over the last 15 years that has been extended to that particular industry. The EITC is the single largest personal income tax credit. The governor's been proud to support increases in the EITC. We have one of the most generous EITCs, state EITCs in the country, and it's the largest personal income tax credit that we have. With that, I'll just move to my conclusion and reiterate that our recession stress test told you that we have enough in the BRF to weather a mild recession without a lot in the way of other changes. But if we had a moderate or severe recession, we'd have to make some tough decisions. Our long-term liabilities are down $15 billion over the last 5 years. Very good news. And the funded ratios for our pensions have increased up into the 60% range. We need to get into the 80s to really feel comfortable about that. So a lot of work yet to be done on that. And there it is. Revenue growth in the STF, it's not keeping pace with our cost growth. So the growth in debt service is a big driver there. So we're going to have to, this next session, make some decisions about the STF. And the total general fund revenue growth is roughly aligned with projected growth we see in combined fixed and non-fixed costs, but we're going to require some policy decisions to remain in balance. And the biggest drivers there, as we indicated, is active and retiree state employee health care, Medicaid, and debt service. And that concludes my remarks. Happy to take your questions.
Thank you. I have 2 questions. One, is the partnership plan included in any way in this, or is it added into any of the expenditures? Are there state dollars that are spent on the partnership plan?
No, it's not included in our numbers.
Anybody know?
I'd have to double check for you. I don't think they are, but we'll double check.
And if we could get something back on that, on the partnership plan itself, where it is in any way in the budget. And on the STF, we paid down debt service. Did that have a negative or positive impact on what was happening relative to the out years of?
Yeah, because you're probably
It definitely had a positive impact, at least short term, but it wasn't by itself enough to obviously obviate the longer term problem.
I was curious about that because we had talked about that. Representative Walker and I had talked about the paying down of the STF debt and what would be the impact in the out years. And I'm kind of surprised by the fact that it does not seem to have addressed some of the issues in the out years.
It probably did address it to some extent, just not nearly enough. We had closer to $1 billion in cumulative surplus. We used about half of that to pay down those bonds, and we don't have, the threshold is about where it is now, so there's not an excess to be used going forward. Saved us $67 million, I'm told.
Okay, thank you. Are there any questions? Representative Paleto, followed by Representative Nuccio. 2.
I'll be brief. Thank you, Senator. Good afternoon. And to Secretary Beckham, thank you for your service to the state. I think I can speak for everyone on this side of the aisle. We really appreciate the effort that you've brought to the position. And I'll just echo a few of the words that you said, I think, around the fiscal guardrails, the fact that we've kept those mostly in place. That's a credit to everyone here. I say it often, but when I first got here, it was a much different time in the state of Connecticut, and I think we've reaped the benefits of those guardrails, so we should continue to uphold those. So my question, and I'm not sure if it's going to be for Mr. Ayers or Secretary Beckham, is around the STF. I know we spoke about this. I don't know why the microphone's kicking back, but I know we spoke about this quite a bit. And last year we had this conversation about the deficit in the out years. It's concerning because folks pay money into this. There's projects that are backlogged, And these projects are vital to economic development in the state of Connecticut. I mean, we're talking roads, bridges, all sorts of infrastructure. And just in my area, we've seen a number of investments in the Waterbury train station, et cetera. So what is the plan? Should this fund go insolvent in the next couple of years? What's the plan? Is it a new revenue stream, or is it going to be cuts elsewhere? How would we backfill the loss of revenue?
DOT and OPM are working on that problem. The governor will have recommendations in February. There may be some options to use some different ways of financing these projects. You could extend them longer than 20 years. Bridges last longer than 20 years. Maybe we could finance them for longer than 20 years. The federal government has some programming that I know that Commissioner Euclid is exploring that might also help us there. Knowing the governor, I don't think he's going to propose that we pull back much on the expenditures. He's very proud of the improvements that we've made. And as you point out, we've made historic improvements in our traffic flows around the state. Big spending program in the last several years, lots of jobs created. It's a good thing. So I think my guess is we will lean into figuring out how to keep that going, but we will have to figure out new ways to finance. Revenue might be a part of that. That's to be determined, at least in terms of the recommendation that the governor will make. But this is a vigorous conversation I'm sure we'll have with the Finance Committee and all the other relevant committees.
Thank you. And I know, again, I lived through the tolls debate, and it certainly wasn't, we all did. And it certainly wasn't a pleasant time for many of us that oppose tolling. But when I see, year after year with a deficit,
So
I'm concerned that, perhaps that discussion could come up again. So I'm optimistic it won't, but I'll just leave it at that.
if we
Thank you.
could, so I'm going to ask everybody not to do the opinion stuff. We have a lot of people that want to ask questions, and we have a hard stop in 28 minutes. So I just want to get this through. Representative Newt, followed by Senator Fazio.
So weird. I pushed a button and it kicked you off. Okay, so I have two questions. One is in regard to the healthcare costs that we have here. I know Senator Austin asked about the partnership plan. I too would like to understand where those dollars are, because I am hearing that we are significantly overrun there again. So I would like to understand where that comes in as a taxpayer being the backdrop. But in regard to healthcare, it is one of our major drivers, whether it be Medicaid, employee, or retiree. I've been trying to get information and looking at the Medicaid spend and trends and in the healthcare area. We've put a lot of programs.
And so that happens now in office. Yeah. So
We've put a lot of programs in place that are supposed to be reducing our cost, especially in the employee healthcare and the retiree healthcare. But all we're seeing is inflationary costs. So I'm wondering if there is any documentation. Probably do not have it now, so that's fine. But I'd like to understand the programs we put in place to reduce cost, whether or not they have actually reduced costs, because we're just seeing increased growth. So I would like to understand the programs and what we have garnered for savings from them. The second question that I have is in regard to some of our overruns. You'd mentioned that HR1 has some significant implication to SNAP and the administration costs for the state of Connecticut. I believe I'm fairly up to speed with exactly how that's working. Going forward, though, looking at that, does it anticipate the fact that Connecticut is not willing to share information with the federal government and the threat that if that's the case, we will lose SNAP benefits? Is any of that taken into consideration with your SNAP growth estimates for the budget?
We don't have anything built into our numbers anticipating that. That is of some concern, and I know that those that analysis and discussions are underway.
Okay. You had also, in that same vein, mentioned that this does not account for the 500 million that was just set aside. My concern is that Connecticut does not share the information, which then creates an issue with SNAP, where we would have to tap into that 500 million to be able to fund it. And then on top of that, whatever other administrative adjustments we would have. Is that the intent that we're looking at from the state of Connecticut at this point?
I can't speak to intent. I had referenced, the SNAP administration. That is a fairly concrete number, $31 million, something like that. Basically, right now, the feds, I think, pay about 75% of the administration cost. That's going to go down to 50%.
Yep.
That's the number I was referencing. I wasn't talking anything beyond that,
Okay, so I think the intent is more aimed at OPM then.
hopefully.
I'm aware that there is a controversy about that. I haven't talked to Commissioner Barton Reeves about where we are on that. But our numbers don't show a reduction attributable to what you're discussing.
Perfect. Thank you so much.
Senator Fazio, followed by Senator Cohen.
Thank you, Senator. Thank you, Secretary Beckham, for your service to the state. I think you earned a reputation for fiscal moderation, and I certainly think that our state government will not be better off with you cycling out of that role. So thank you again for your service. My first question is, you mentioned that in the 8 bond presentations you've done, that the bond rating agencies love our fiscal guardrails. Conversely, do you believe that this puts our ability to see any rating increases at risk in the future, since we have significantly altered the volatility cap and worked around or gone through the spending cap in recent years?
We had a round post this session, and we explained all that to them, and they were satisfied with what we did, and did not, in fact, they upgraded us. So they did not take a negative view of what we did this past session.
All right. Second and last question is, the context for this presentation. These are very good presentations. I think they're informative to the public. But the context for this presentation is obviously that Connecticut continues to have one of the highest tax burdens of any state in the country. It's particularly burdensome on the middle class and working class. Is there a strategy, given the outlook in the long run, for a rough balance to these numbers? Is there a strategy in the administration for reducing the tax burden in the long term, and finding savings and reductions to taxes in that context?
The governor was proud to propose and was happy that the General Assembly enacted the largest tax cut in the state's history, continues to look for ways to find savings for our residents. And I'm sure they will continue to look at that. I'm not in a position to telegraph where the governor may be in February and what the situation will be then, but I know that it's something he's taken pride in having done in the past, and would love to find a way to do so in the future.
So we'll look to February. Thank you, Senator. Thank you, Secretary.
Senator Cohen, followed by Representative Dathan.
Thank you. Just trying to take care of a technological issue I have here. Madam Chair, and thank you, Mr. Secretary, as well as the OFA. I'm appreciative of the reports today. As you might suspect, I have concerns over the Special Transportation Fund. I noticed in the accountability report, there's a relaxing of bond issuance as we move forward. It's at 1.3 billion in FY26, and then relaxes out to 1.1. I'm concerned for the reasons that you just stated in an interchange with Representative Paletta, in that, I think relaxing too much on bonding could present a whole host of other issues for the state of Connecticut, including deferred maintenance, which, presents even more issues. I think it can inhibit our credit rating. Certainly, we know that creating these construction jobs is good and vital for our economy, and having roads in well repair is certainly also good for our economy. We don't want to relax on investment in terms of bus and rail. We want to impact vehicle miles traveled for our environment, for quality of life, and for road usage. So I just sort of wanted to get a sense on that relaxing of bond issuance, if we are doing that to ensure that we're honoring the covenant and that 2 times debt service ratio. And if we are giving thought to future revenues, because I really think that is incredibly important to make sure that we continue investment in our roadways across the state.
If that's to me, yes, I think the governor agrees with what you just said. And we will be looking for ways to continue the historic improvements that we've been making in the transportation system, including mass transit. But they are increasing costs and the debt service is going up, and we're going to have to take a look at that. We're not showing anything in our numbers that represents a pulling back on investments. We are simply, that's one scenario that's related to some technical out year numbers, but we're not only off by 100 million, I think. But we're not signaling in these numbers any pullback in the investments at this time. As I say, it's been my experience that the governor is very proud of what we've done in transportation to date and would like to keep going with that. But we've got to look at some ways to close this gap. We've got to stay in balance, and we've got to get the debt service at a sustainable rate.
Wonderful. Thank you.
Thank you. Up next is Representative Dathan, followed by Representative Corpus. And if you two gentlemen wouldn't mind sending us the presentations, I know they match the FAR report, but send us the presentations. We'll send them out also. Representative Dathan.
Thank you, Madam Chair, for asking one of the questions I have, so I get one more. I just wanted to say, first of all,
Nice
thank you.
try.
Thank you so much, Secretary Beckham. It's been wonderful to work with you, and you will be greatly missed, and glad you're still going to be in our state working and contributing. And thank you to OFA for all of your work. The first question I had was regarding CBAC. In our out years, we have a decrease from 153 million down to like 122. I couldn't remember because it was on one of the presentations. And I'm wondering, does your CBAC calculations in the out years take into account retirements? Or how do you calculate kind of going out years for those amounts?
We can get you more detail on that. We did not make granular assumptions on a lot of that. We just looked at past patterns. A lot of times there's some of the first year, some are backloaded, so it's a bit higher. But we can get you the details and the assumptions on that.
So the increases are in line with what we have been seeing in our increases in our current CBAC arrangements, is what I'm understanding.
We looked at recent patterns and
Okay.
used that as an assumption. As I said, we have no great insight. I'm not involved in the negotiations.
Yeah, of course. Also wanted to kind of delve a little bit deeper into the Medicaid, and it might be outside of the scope of this meeting for today, but if you could maybe provide to the administrator some of the assumptions that you have around Medicaid growth. In particular, I was surprised to see we have some lapses within, I think you said Medicaid Part B, the Husky B.
Husky B, yes.
And also just wanted to get an overall sort of sense of where we are with each Medicaid program. I know that's a lot of detail. Don't expect it for this, but if you could maybe get to us at a later time so we can see how the assumptions build up, not just for the current biennium, but for the 28 through 29 growth.
You beat me to the answer in saying there's not one calculation for Medicaid. It's a very complex
Sure.
program, but we can get you the details and the assumptions.
I'd appreciate it. Thank you so much. Thank you, Madam Chair.
Thank you. Representative Corpus.
Thank you, Madam Chair. Thank you, Secretary Beckham and Director Ayers, for your service and your excellent presentation. I had two questions. The first is, I think you had said that as a result of the $500 million fund the legislature approved this year, that if all of that fund is appropriated by the governor, it will cost us $41.5 million in 2028 and beyond. That is, it will take that $41.5 million out of the budget in those forward years. Is that correct? Did I hear that right?
Essentially, yes.
Okay.
Basically, if we had deposited that from FY25, there's a lag where you get the benefit in the lower ADEC of about 2 years. So by not depositing that in 25, our ADEC is 40 or so $1 million higher than it otherwise would have been in FY '27. If that never waterfalls, that same level would continue into the out years.
Okay, and that's a result of that 500 million not being invested and not earning a rate of return. So my question is, do you have an aggregate number? Because in addition to the 500 million, we've also adjusted the volatility cap by 600 million in 26 and 27, and we've taken approximately 300 million out for the early childhood endowment. Is there an aggregate calculation of what all of those legislative actions in 2025 result in terms of forward increased ADEC payments?
I'm
If you
sure,
don't have that now, perhaps we could
I'm sure,
get it.
sure there is, but I don't have it at hand. We can get it to you.
Okay, that would be very helpful.
I can offer, if you, for every 100 million that you pay down the principal, you get about 8 million in ADEC savings. That's the rough rule of thumb that we use at OPM.
Okay. Thank you. And the second question is on the CBAC agreements. It showed aggregate numerical increases in the out years. And I know you said you're not part of those CBAC negotiations, but what percent increases do the numbers that you showed on your slide reflect? I mean, in the last 6 years, the CBAC, the state employee wages have increased either 5.5% in 2 years or 4.5% in each of 4 years. What do the numbers that you showed on the screen reflect? Is it an order of magnitude about that size?
In that ballpark, we can get you what they actually are. As I said, those are somewhat placeholder based on past patterns, but we can get you what those equate to.
Okay. Okay. Thank you. That was all my questions. Thank you again.
Thank you. Representative Lesser? I mean, Senator Lesser. Huh? Senator Lesser? He's online. Okay, we'll move on. Representative Farrar?
Thank you. Thanks, Madam Chair. Thanks, everyone. I will be quick. With the revenue estimates, and this could be for both OFA and OPM, I know one of the topics of conversations we've had with both of you and with our Department of Revenue Services is the reporting that we've done recently in the state to acknowledge our tax gap, which is approximately $3 billion of folks who owe taxes but have not been paid. And I know DRS came out with some tax strategies just a couple months ago to indicate that even though they have been down approximately 20% staffing, based on their staffing, they could bring in an additional $84 million with some new strategies. And I wanted to know if that estimated amount was included in either of your revenue estimates.
No, it was not included. I did have an extended colloquy with Representative Horn last year at the Finance Committee on that very topic. I commend my comments that day to you. I'm personally skeptical that that's an issue of adding more personnel at DRS. We've had the so-called tax gap for many years. We sometimes have amnesty programs, and we've had IT programs to try and get at who those folks are and who we should audit more often. There are some strategies out there. I'm a little skeptical that there's some kind of a pot of money there that we're going to be able to grab by adding more personnel there. But that's obviously something you can talk about in February.
Yeah, thank you for answering that. And is OFA including that $84 million estimated by DRS of additional revenue based on their new strategies, which do not include new staff?
Based on consensus revenue, we have the same assumptions as OPM.
Okay, thank you for that. And then just one other quick question about just kind of the year-to-year surpluses we've seen, and I know on our end as a legislature, this year there were, significant dollars that came in subsequent to the close of our session, and I was hopeful to hear from both of you, how you suggest, our processes really more accurately estimate the revenue that we can expect so we can make the best decisions for all of our constituents.
One of the realities is, particularly in a short year, the budget has to be adopted in early May. Tax funding or the filing is April 15th. We have a few days to get you information. A lot of the state's revenue comes in after that time, even after you pass the budget. We make estimates based on what's in the door, but it's a timing issue. Unless you change to adopting a budget in the fall, we'll have a much better picture, but it can go either ways. This year's, it came in quite positively and quite strong. But it's really a timing issue.
I would observe that what came in and what comes in every year, a big, is estimates and finals and volatile revenue that is not available to you in the general fund. It's going to the budget reserve unless you increase the volatility cap threshold. So it wasn't usable money for either the General Assembly or the administration under our current law.
Thank you both for that. I think we have to continue to be thoughtful about improving our work, right, on behalf of our constituents and how we are using their tax dollars effectively. So I hope we can keep working towards that goal so we can have the best information possible to do that. So thank you, Madam Chair.
Thank you. Senator Wang.
Thank you, Madam Chair, and congratulations on your retirement, Secretary Beckham. Look, as the ranking member of Transportation and also the ranking on the Subcommittee of General Obligation and Special Transportation Fund, I want to focus on the positive momentum that we've had in transportation infrastructure, and kudos to the good work of DOT Commissioner Eucalito. But I think that needs to be maintained. And what the latest report says that there are some real concerns about sustainability into the 2030. I just wanted to be able to reiterate that as we look at unpredictable and volatile fiscal pictures moving forward, that we have the commitment that the STF fund will be properly funded and planned out to ensure that these projects, as we have gained momentum positively to making infrastructure improvements on our roadways, rail, and transit systems, that that commitment is there from the administration moving forward, and that their funds will be fully funded to move forward, as the chair of transportation articulated earlier.
Continuing a robust program of making improvements, I'm sure remains the goal of this governor.
What were some of the examples that you would give in regards to the funding mechanisms that you would be looking at? Are we going to possibly explore the opportunity of dipping into the volatility fund and other excess funds if the revenue does not match up, or the sales receipts that don't match up to it?
I'd be surprised if that was a viable option for the STF. I think it's more a question of, as I indicated, financing options that maybe are available under federal programming, our own ability to change the way we finance those bonds, those STO bonds, as well as other revenue sources that we will have to take a look at.
Is there a concern in regards to the recent news of the shortfall projections going into 2030 in the STF funds, or are you confident that it will be fully funded moving forward and that perceived deficit will be supplemented?
Senator Wang, that is 3.
Oh,
Thank you.
thank you, Madam Chair.
They can send it to you, answer in the mail. We'll be very glad to get that.
Thank
for
you, Madam
Okay.
Chair.
Thank you.
Happy holidays.
Happy holidays. Is Senator Lesser online? No. Okay. Are there any other questions from any of the people in the, yes.
Second bite of the apple.
Yes.
Oh,
Thank you, Madam Chair. Great to see you both, Neil and Secretary. Congratulations to you, and thank you again for your service to our state. You noted earlier large unknown fiscal impacts due to HR 1 beginning in 2027, some of them work requirements, et cetera. To date, has the administration or have you sought any guidance from the feds with respect to programmatically how that will ultimately impact your finances?
Well, yes, the relevant DSS, principally around Medicaid and SNAP, are in constant contact seeking guidance. I'm not sure, that's probably a better question for Commissioner Barton Reeves, but yes, with OPM, we are discussing and assessing what those impacts are going to be, and they'll be part of our budget proposal for 27. There may, don't want to foreclose the possibility, there may be something announced before that. for the current year, but that's all under discussion. Yes.
'Cause I know there has been some issue about getting an answer about any form of guidance on issues or policy relating to HR1. So
I
thank
can
you
say
for
our
due
ex-
diligence.
Yeah, our experience with the federal government, this administration particularly, is it's very difficult to get good, consistent information. Sometimes you get information and it changes, but I know that folks at DSS especially are working hard on that with regard to SNAP and Medicaid.
Appreciate your persistence and commitment to our state. Thank you both.
Okay, and the final question will be from Representative Winter.
Thank you, Madam Chair. Thank you, Neil, and thank you, Secretary Beckham, and thank you for your service to the state. Secretary Beckham, you mentioned a couple times potential changes at the federal level that could impact, I think, borrowing costs for the STF. And I was wondering if you could shed any light on that.
Yes, we've been discussing, Commissioner Euclid could probably give you much better detail on this, but there are several federal programs, federal acts involving both rail and highway that offer some financing options for states that are more generous, that have different terms. And we will lean into, I'm sure he's leaning into those and trying to figure out ways to get the same bang for the buck, or at least the not have the increases that we're looking at for transportation costs in the out years. And so those are being reviewed today.
Thank you. Thank you, Madam Chair.
Thank you. And I want to thank the two gentlemen and their committees, the teams that are here today to present the FAR report. I think you did a fantastic job. The only question that I had was in trying, for those of us who are not in the field of finance, sometimes a reconciliation of the two reports, it gets a little difficult to understand. And I was just trying to say, so that we have more people in the conversation, we want to try and make sure that we provide the information in a way that they can understand it also. So thank you. And Secretary Beckham, it has been a pleasure working with you, and I've learned a lot, and I thank you, and I hope you've learned a lot from us. And I look forward to I look forward to working with you in your new role as you roll into the other areas. So thank you very much, Senator. I said Senator Horn. No, Representative Horn.
Madam Chair, I just wanted to add my thanks to the Secretary for his service, and say that even when we are jousting from different sides of the thing, I have enjoyed it. It's a good intellectual and honest debate. I think it makes the state better. I think it gets to a better policy position. So I thank you and wish you best of luck in your new endeavors. And as always, my deep gratitude to OFA and every single person in that office for everything you do for us. So thank you.
So with that, I thank everybody, and it just shows you with the reports, we have a lot of decisions to make. We cannot ignore the fact that we are here for the people of Connecticut, and sometimes it's good to have the large amounts in the bank, but sometimes it's also good to make sure people eat and have housing and have a job and things like that. So it's going to be very difficult for us to make the decisions that are going forward. But we thank you for this, and this is going to roll right into our session in February. So I look forward to all of you being back here for those public hearings. Have a great